Good afternoon, everyone. Welcome to the first in our new series on analytics and automation. We'll be covering a few topics in today's first session. Let me first just welcome our two guest speakers, Roger Alston and Ricky Maloney. Welcome, guys. Thanks for joining this presentation. So, in today's today's presentation, we'll be covering the survey results from our actuarial post-survey, expert judgment, global OTC derivatives reporting, and process automation. So first, let me just quickly start with a little introduction on something. Hey, no, welcome. Being human. Essentially, Martin Wheatley, the FCA chief executive, very recently said in a speech that wealth and intelligence were no guarantee of good financial decision making, as common investment mistakes are, in inverted commas, human. And this comment was based on FCA research into cognitive biases. Basically, people are generally bad or even terrible at intuitive statistics, and they're prone to making systematic errors in decisions involving uncertainty. Now, as one example, I think most of you have probably heard of the Monty Hall paradox, where you're presented with 3 cups with the prize being hidden in one of the 3 cups randomly. And when a participant is presented with this problem, and then one of the cups that does not have the prize is randomly removed, and then presented with the option to switch to the other cup, most people would intuitively stick with the cup that they've selected from the start, whereas actually, if you switched, 2/3 of the time you'd win and be better off, basically. Now, pigeons are actually very good at this, because when presented with the same problem on day 1, most pigeons stayed with their initial selection, but over a 30-day period, almost all the pigeons learned to swap to the other bucket for the prize. So pigeons, very good at solving statistical problems. Humans, not so good. Bizarre. So, first our survey results, which we ran in conjunction with the Actuarial Post. We had about 100 people taking part in the UK, mostly qualified actuaries. This was specifically targeted at the actuarial sector. And as you can see, we had quite a broad mix of respondents in terms of seniority in the company. We had a reasonable representation from executives, senior management, middle management, and all the way to analysts and external consultants. An area we specifically focused on was to check how satisfied people were with their actuarial processes, and we asked them on satisfaction levels of various elements of those processes. So we focused on the time that it takes to run the process, the effort involved, the number of people required, input vulnerability, ease of linking inputs to outputs, and computer reliability. Now, what we saw was quite interesting is that it seems the investment in IT infrastructure over the last 10 years is actually starting to pay off, because computer reliability seems to be the area where most of the respondents were quite happy with their computer reliability, compared to all the other areas where the satisfieds and the dissatisfieds were sort of neck and neck. In one of them, which is the one we marked red here, there's actually a majority of respondents dissatisfied with input error vulnerability. So this actually got us thinking about what the risk factors are within actuarial processes. If most actuaries seem to think that their processes are quite prone to input error, that may be something we need to focus on. Then we also did a few questions on the time it takes on various parts of the actuarial processes, and we asked roughly how long does it take to perform monthly reporting processes. Now these processes, by their very nature, need to occur every month, and if you're spending 20 plus working days every month working on this is not one person, or sorry, if two people work on it 10 days each, that's still only 20 working days to, that's only 10 working days to perform the process. So this is actually the calendar time elapsed. And what we found is that a very large proportion, almost a third of the respondents actually saw their processes took about 20 plus days to cover, which is basically a never-ending reporting cycle, basically endlessly working on reporting, and you're almost always about a month behind in knowing where your actuarial results are. Then we also looked at the time it took to document processes, and on this we saw a large number of respondents said 1 to 2 days to perform the documentation. But as you can see, a very reasonable chunk, still 10 days and plus. So, but we're not convinced that a lot of this time is in terms of efficiency, but rather a lack of availability of time. Because the process itself takes so long, there's very little time left to actually document, and similarly, to create audit trails. So even here, we see there's about 10% of respondents taking 20 plus days to perform the work required to create an audit trail. Then we moved on to the area of spreadsheets, and now this is really the bigger area that we focus on in terms of risk. We found that 75% of the respondents say that they use spreadsheets to store assumptions, and 70% use spreadsheets for major calculations, and 40% use it to transform data. Now, these are quite sizable percentages. Now, using spreadsheets to store assumptions and perform major calculations and to transform data is a very risky strategy. So from a risk management perspective, this is actually quite risky, which essentially those three combined issues were pretty much behind the London whale event, where an investment bank here in London recently lost something like $6 billion because of a spreadsheet mistake, copying and pasting incorrectly, using it to calculate their derivatives exposure. So, and a little bit of, shall we say, lack of expert judgment in setting the inputs as well in those spreadsheets was part of the reason why that occurred. So that's just a quick summary of the actuarial survey results. We've got a few printouts ready for you to take away if you wanted to take that with you after the presentation. And I'll now hand over to Roger to speak about expert judgment.
Okay. So I'm going to spend the next few minutes chatting about various aspects of expert judgment, and hopefully by the end of those few minutes I'll have succeeded in some manner to demystify it, at least to a small extent. Go on to the next page. Now, I'd just like to draw your attention to the kind of disclaimer at the bottom here. So although my views have been informed by my work on the actuarial profession, Solvency II research group, everything in this presentation is my personal view and not necessarily those of the actuarial profession. Disclaimers out of the way. We move on to the introduction. So I guess before getting to expert judgment, it's probably sensible to think, well, what is an expert? It's quite a difficult kind of concept to pin down. When I was doing research on this, a flavour that kept coming up was, well, an expert, you'll know one when you see one, which isn't that helpful. So I reverted to Wikipedia, and although perhaps not the most succinct definition that you'll ever come across, it does actually encompass most of the aspects of who an expert would be. So an expert is someone widely recognized as a reliable source of technique or skill, whose faculty for judging or deciding rightly, justly, or wisely is accorded authority and status by their peers or by the public in a specific, well-distinguished domain. So an expert can be, by virtue of credential, training, education, profession, publication, or experience, and is believed to have special knowledge of a subject beyond that of the average person, sufficient that others may officially and sometimes legally rely upon the individual's opinion. So to say, not the most succinct definition, but it does encompass, there's lots of different aspects to experts. So now that we have a working definition of an expert, what is expert judgment? Well, the first thing to say is it's nothing new. You know, actuaries have been doing this since the profession started. And it's important in other professions as well, so like the medical profession, legal profession, they apply expert judgment on a daily basis. So we've only got a few minutes here, so I'll confine my thoughts to kind of financial services sector firms' balance sheet. And in that kind of context, expert judgment is inherent in a wide range of areas. So some examples here are choice of methodology, modelling methodology, choice of data sets to use, how to deal with insufficient and unreliable data. There's a wide range of aspects. Now, we could potentially take the view that any assumption is, in some sense, expert judgment, but that's not the most helpful. I think expert judgment definition needs to take into account materiality as well. That's quite helpful. So is it important? Well, you know, just looking at the likes of kind of Equitable Life, HBOS, Lehman Brothers, you know, those companies, I'm not saying expert judgment was the sole reason for their failures, but I would suggest that it was at least a contributing factor. So I would say expert judgment is absolutely critical. Okay, now given the time constraints, I'm just going to pick out two important aspects of expert judgment and focus in on those for the rest of the talk. So the first of these is governance. Now, I believe that a robust governance framework is absolutely critical for the success of expert judgment, applying it effectively. And materiality and proportionality are also very relevant. Now, again, these are terms that are very difficult to pin down. They're often used by people in abstract, but I think in terms of expert judgment, I think it probably affects things like the amount of documentation required, the amount of validation to be applied, and the level of monitoring of those expert judgments. A way of thinking about expert judgment is a judgment's made and there's a level of uncertainty around that judgment, and as a consequence of that uncertainty there's an impact on the results, and potentially an impact on the use to which the results are actually made. So for example, if there's a high level of uncertainty, the consequent impact on the results is probably going to be quite large, quite broad, and so would you use that model to actually make decisions? You know, so those kinds of ideas I think is quite helpful when thinking of expert judgment. I think the governance framework should include expert judgment, materiality and proportionality policies. Now, although that's not absolutely essential, I think it's quite helpful in terms of an effective way of communicating how the company goes about its expert judgment, helping to ensure consistency. So a key part of the expert judgment policy, in my view, should be the process to be followed for assessing potential expert judgments. So we'll just come on to that. So I see this as a series of steps. The first one is the judgment actually within the definition of expert judgment? Does the policy apply to that? The next step would be an initial materiality assessment, and this is really to assess the level of proportionality to apply. And what I'm thinking here is that this is a very quick, broad brush assessment. So is it the assumption concerned, is it a material part of the model? Is it likely to have a high impact on the model? So it's just getting a sense of things at this stage. Then the context of the judgment, like why is it needed and how will it be used? Does the expert have kind of relevant knowledge, understanding of the subject, adequate experience? And then identification of potential sources of information that can be used to inform the judgment. Now, there's a wide range of sources there for many expert judgments. Some of them could be dealt with through, potentially automated through data analytics, but others are, academic research papers and so on. So there's a whole range of things there that need to be taken into account. So really, to paraphrase these initial steps of the process, I would say that, the first one, initial materiality assessment, doesn't matter. The context of the judgment, how will it be used? The expert, do we have the right person? And then do we have all the relevant sources of information? So the next step really would be the identification of key drivers underlying the judgment. And the guidance around avoiding potential bias, which is a real risk in terms of expert judgment. Assessment of a plausible range for the expert judgment, robustness of the analytics supporting the judgment, and sensitivity scenario analysis around this. And after that's been performed, then a reassessment of the materiality in light of that extra detailed analysis that you performed. And at this stage, you might discover that you thought it wasn't a biomaterial assumption, but it's actually more material, so you need to go through the loop again in terms of honing in a wee bit more detail on things. And of course, documentation as well. So I think my feeling is throughout this whole process, consistency is really quite important because it adds to the credibility. If you're making an expert judgment or numerous expert judgments, having consistency across them is helpful. So kind of a consistent story across the judgment. So effectively, you want to say, here's our view of the world, here's the evidence for that view, and used to form the opinion. Okay, so moving on to the last bit that I want to touch on. This is documentation. Now this is a subject that's quite close to my heart. I have advised a number of companies in the area of documentation. And I think documentation of expert judgment really needs to fit into a wider documentation framework for companies. It's it's not a bolt-on. It should be consistent with other documentation. And I think for documentation to be any use, you really need to be thinking about it has to be useful to the business. It's not a box-ticking compliance exercise. So for it to be successful, it needs to be useful to the business. So in terms of expert judgment, the level of documentation should be proportionate to the materiality of the expert judgment. So if it's not very important in terms of materiality judgment, you don't want to be spending ages documenting it to the nth degree. You could use tools such as an expert judgment register to capture the templates as well to ensure consistency in capturing the expert judgments. You need to document the sources of information used to inform judgment, including market practice and how they're used. But you need to also be mindful here of the risks associated with following the herd in terms of market practice. So an example of this might have been credit derivatives a few years ago. Some might suggest that the current stock market levels are perhaps unsupportable with fundamentals, but that's another topic for another day. Other areas that to document are key drivers upon which the judgment depends, kind of related judgments. Again, this is coming through with the consistency theme. And then a plausible range of acceptable judgments and how the sensitivity of those on the various metrics are actually performed. And then final areas of documentation are aspects such as when the judgment was made, quite important, the name and title of the expert, and you should note that the expert may actually be a committee rather than an individual. The credibility of the expert, validation and challenge processes applied to the judgment. Now, I could spend an afternoon talking about this topic alone. That's a big area of expert judgment, how you validate it. Scheduled date by which the expert judgment must be reviewed, and kind of key limitations and triggers for non-scheduled review. So just to conclude then, expert judgment is inherent in many different aspects of financial models for financial sector firms. And there's nothing intrinsically wrong with expert judgment. Rather, I believe more rigor is required around it. And I believe this rigor can be achieved through robust governance and good documentation, and the documentation proportionate to the materiality of the judgment. Now, I believe that there's certainly implementation costs in getting such a framework up and running, but I think they're small relative to the potential benefits, giving senior management a better understanding of those grey areas underlying the figures, and that's quite helpful to senior management. So I'd like to leave you with kind of one final thought on this. Kind of the implications of inappropriate or unfounded expert judgment can be far-reaching. So for financial services sector firms, it could mean capital add-ons, but it's for the individual themselves that could have serious reputational damage. I think this is particularly well illustrated by, I don't know if you recall back in 2012, there was a court case in Italy under which a number of preeminent seismologists were actually sent to jail because they hadn't provided enough context nor appropriately communicated the level of uncertainty around their predictions. So on that cheery note, I'll finish and pass back to Daniel.
Thanks, Roger. And I think the next set of slides is on OTC derivatives. So over to you, Ricky. This is yours.
Well, firstly, having seen the definition of an expert, I'd like to put my own disclaimer out there immediately. So I'm certainly not one of those. But I have been working in the city for around 20 years, the last 10 years of which have specifically been spent working with derivatives. And my current remit is one of implementation of the regulations, the sort of tsunami, if you like, of regulation that the industry currently sees. And I'm delighted to hear that there are two master's students in the room studying that very thing. So I might be over to you later for some information. So do you want to move on? Well, actually the slides aren't very clear, so I'm probably going to have to do this from memory. But just some background of why this regulation has come about. So in 2008, you'll recall the financial crisis, which realistically began with Bear Stearns being absorbed by JP Morgan. In March of the same year, I can't read this, in March of the same year, Lehman Brothers collapsed. Merrill Lynch would also have gone under if Bank of America weren't forced to buy them or encouraged to buy them. The same would have occurred with with HBOS if Lloyds hadn't been forced to take those over. The UK Treasury pumped 37 billion into the economy, and in the US, the Troubled Asset Relief Program, TARP, was instigated, which was essentially a $750 billion emergency credit line for US businesses to tap into to ensure their survival. Now, so what the regulators said at the time was, this is unacceptable. There was a seriously inflated level of risk within the derivative space that the regulators didn't have a handle on. So they had no view of, or they didn't have a great view of who had what type of exposure to who. And you also have companies, so in the example of AIG, they had somehow negotiated to trade credit derivatives without exchanging collateral, and they would only exchange collateral if their bonds were downgraded. And of course, when this happened, within the space of 2 or 3 days, they were hit with collateral calls of $105 billion, which quite simply they didn't have. So the regulators said, you know, enough's enough. We can't have that again. So in 2009, following a meeting of the G20, they came out with a statement that all standardised OTC derivative contracts should be traded on exchanges or electronic trading platforms where appropriate, and cleared through central counterparties by the end of 2012 at the latest. OTC derivative contracts should be reported to trade repositories. And that's the piece that I want to focus on today very quickly. Now, where it says OTC derivative contracts should be reported to trade repositories, since that's been extended to exchange-traded derivatives, foreign exchange, the exchange of collateral, and the valuation of derivative portfolios. So just some statistics here, just to give a flavour. Okay, that's nice. Just give the flavour. So in December 07, the total notional in $1 trillion terms of outstanding OTC contracts was 586. By the end of December last year, it's $632 trillion. However, following adjustments for cleared derivatives, the removal of FX, and the adjustments for credit default swaps, because when you clear a trade within a cleared environment, it's double counted, because I've put 5 million, you put 5 million, that counts to 10, so that has to be netted. So the adjusted OTC volume in December 2012 was $392 trillion globally. And if we, on the second table, what we see is that the 70% of that market is collateralized, and adjusted for credit exposure after netting being I owe you 50 billion, you owe me 38 billion, therefore I owe you 12. It's as simple as that. So the percentage of gross market value that's uncollateralized is 4.4%. So that's $1.1 trillion that is credit risk, pure credit risk. There's no collateral exchanged whatsoever. So what what regulators are saying, look, let's get away from that. And what they propose is this reporting, whereby every legal entity has to register itself. So not a trading firm, every client that firm has, and every entity that client is or owns, has to register with the Financial Stability Board has set up the Regulatory Oversight Committee, and they've devised this concept of an LEI, which is a legal entity identifier. And what that means is, as a firm, my clients have to register with the ROC, they're assigned an LEI, and that LEI stays with any trade that they do for its lifetime. And we've got here the characters that make up an LEI, but they're not overly important. I'm not going to go through those. So, Financial Stability Board has recently come out and said that the global aggregation of trade repository data is essential to enable comprehensive monitoring of risks to financial stability. They're about to launch a feasibility study on how they're going to achieve this. And if I go to my last slide, colours don't work too much. So under here, this is all of my legal entities that my firm trades for. Every single one of those companies has to go and get themselves an LEI. Every time they trade, that LEI is appended to a trade. So here's my firm, the asset manager. We're merely trading on behalf of these firms here. And we're trading foreign exchange, we're trading credit derivatives, we're trading interest rate swaps, we're trading OTC derivatives cleared and non-cleared. So these are the asset classes here. You can't read that actually, but so you've got FX there, for example. Now, if I trade a swap and clear it through my clearing broker, I could say to them, look, can you report that trade that I have to report by regulation? Can you report that for me? The ETD piece, I need to somehow work out how I can get that information to this local repository here. I've also got to get my credit derivatives in there, my non-cleared OTC derivatives, and I may be reporting to 1, 2, 3, 4, 5 local operating units if I'm a global trader, right? At the top here, this is the nirvana, if you like, that the regulator is currently about to undertake a feasibility study for. So this is the global oversight, this is the global operating unit. And what they're saying is that all of these entities trading all of these instruments have to report that. And this is almost instantaneous. If it's not a clear trade, it has to be done by the end of the day. It has to find its way to this top level. And there are 85 fields per trade to be reported. Not all of them need completion. With an FX, for example, there's probably 30 of the 85. With a CDS, slightly more. But you'll see the problem. My problem as an asset manager is I'm trading with all of these guys. For each trade that we do, we have up to 85 fields of information to provide up the chain from 4, 5, 6 different sources. Now I haven't got the technology to do that. And right now, the technology exists, but I don't know of anybody that's out there attempting to grab this data, aggregate it into the format that we need to report it up the chain. So, quite selfishly, I'm here today to maybe plant the seed in your minds that there is a business, and this is a market opportunity, right? This is a market solution. This is just not something my firm needs. It's a globally required solution. So it's literally take data from 4, 5, 6 sources, put it into a workable format that these guys would accept. If this ever occurs, this global piece, I struggle to see how that's going to happen, to be honest with you. I mean, you're talking about every derivative trade that takes place, and if you consider 22 billion exchange traded derivative contracts every year, the FX notionals we see, $4 trillion a day of FX is traded. So rather than come to you with a solution of any kind or some advice, I guess I'm actually selfishly here saying, here's the problem. You guys are the data guys and girls. So food for thought.
Thank you very much. Excellent. Thank you very much, Ricky. Some of us are maybe a little bit perplexed by some of these trillions of numbers that you're throwing around, because I don't know, I can't quite get my head around 100 billion, let alone a trillion. So. Right, so this brings us to the last bit of our presentation, which is on process automation. So we like to call process automation the best of both worlds, basically. So first, let's just recapture a finding from our survey about spreadsheets. So a lot of insurance companies in their actuarial departments use spreadsheets for important calculations, for assumption storage, and for data manipulation. Now, spreadsheets are pervasive in many industries, not just in the insurance sector. They're flexible and easy to use. They have a perceived reliability. I specifically use the word perceived there. And they are significantly dependent on for major calculations throughout the financial and also other sectors. However, they do suffer from certain vulnerabilities. there's a little bit of a lack of control around spreadsheets. One of the main strengths of a spreadsheet is how flexible it is. That in itself is its main weakness as well. It means it's very easy to edit, alter, change without any of the controls that you might find in a properly controlled modeling environment and also reporting environment. There's a big lack of auditability and specifically documentation that Roger was referring to earlier. And also transparency. It's very hard sometimes to find where an input comes from which has been used for a specific output. We sometimes refer to this as a spaghetti effect, where you have one spreadsheet linking through to a different spreadsheet, but that other spreadsheet then links back to a spreadsheet, and you have these spaghetti links between all these spreadsheets, and then you could end up with a meal rather than a report. Then we also have frequent problems with manual manipulation. If you get people manually typing in values in spreadsheets, you're setting yourself up for human error that obviously your experts could accidentally make. Then you also have key person dependency on a lot of these spreadsheets. Because they are so flexible, it allows some of your candidates in your firm to edit these spreadsheets, and they might work for your company for 2 or 3 years, and they might be the only people who actually know how that spreadsheet works. And once they're not in the office, maybe they win the lottery, or maybe they fall ill, you never know, and then all of a sudden you have a major risk. Now, being human, back to my very starting comment, unfortunately, even very clever humans make mistakes. I know some of us don't like to admit it, but it's true, especially when we're doing manual repetitive tasks. When you employ someone who is highly qualified and you get them to execute some very manual repetitive work, at the beginning they might find it interesting for a day or so, and then after a little while it becomes a little bit boring, and then after a month or two it becomes so mundane that it becomes so standard for them to just do it, they don't necessarily do all the checks and balances that they're supposed to do it properly. Now, we all tend to generalize a small sample to an entire population. That's a big thing that humans do, unfortunately. We tend to be a little bit too confident, and we sometimes see patterns in random data. I know, for example, there are websites where you can track hot or cold numbers of the lottery to sort of determine whether you should be selecting that number or not. A lot of humans actually go for that kind of thing. And we also find it hard to combine probabilities. Now, all of this to us means that in some areas of running a business, it's probably better to not have human intervention in those areas. So that's why we're saying process automation is actually sort of the best of both worlds. Okay? So you can have the flexibility of spreadsheets while reducing the risk of error caused by manual input. So you overcome certain auditability and documentation aspects, as well as the transparency problems, because once you've automated a process in a robust way, you can track what inputs were used to produce various outputs. And then also, if you have an intuitive control mechanism, it makes your auditing framework so much better and can assist in a lot more automated documentation, which, Roger, you'll be happy to hear. So there are lots of benefits to process automation, reducing manual human errors, audit changes, reducing cost and delivery times, freeing up your skilled staff to do more interesting work, frankly. That's actually a major thing to free some of these individuals who are caught in this day-to-day mundane process where they're repetitively doing something which doesn't necessarily involve their skills and not necessarily their qualifications, where you can free them from these mundane tasks and maybe grow your business by reapplying their skills in an area which requires those skills and qualifications. So, a quick discussion on hosted solutions. So, automation is one aspect, but then how do you automate something? Now, we've found that in the last year, and certainly in the last couple of years, hosted solutions have really grown, and the availability of solutions you can get out there that are hosted have just grown exponentially. So you've got platforms which are hosted in the cloud, so to speak. That's another word people use to describe hosted solutions. And the benefit of those is they don't require new computer hardware. That's a major thing for a large company that needs to implement something. If you need to first buy all the hardware and then need to get rid of the hardware in a year's time when it's out of date. Also, you can start automating your processes immediately if you use a hosted solution, because you don't need to wait for IT to contact the vendor, and you've got a preferred supplier vendor who doesn't sell the server and the CPU that you're needing, or it doesn't work with the software platform, etc., etc. And so you're quickly talking about 6 months of delay before you can start even working, whereas with a hosted solution you don't have those kinds of problems. Obviously that brings with it this whole problem around security. So a lot of us know about our data being out there on various cloud platforms. Some famous contractors of security agencies are gallivanting across the world from Hong Kong to Moscow specifically because all of this data seems to be just randomly being accessed by whoever. So security is a major problem. Now, if you're on a hosted platform, you obviously need to have it fully encrypted and completely secure. And then that's one aspect. The other aspect is if that hosted platform, the device that it's running on, or devices, crashes, and obviously you need the backups. So you need those two things, certainly, in your hosted solution, if you choose one. So we predict that hosted solutions will soon play a significant role in reducing the cost and increasing the efficiency around actuarial processes specifically. So we found from our survey that there is a lot of manual intervention, a lot of use of spreadsheets, lack of control. All of this really tells us that there are major risks, specifically in the insurance sector. But my guess is the same could be said of the banking sector, having seen so many banks fail recently, and the shoddy processes involved in a lot of these large-scale contracts and derivative structures that they put together, where they base all of their calculations on a few spreadsheets which seem to have been put together over a very short period and then used over a prolonged period of even years, and where the underlying calculations are no longer applicable but just copied and pasted across. So we really see hosted solutions as playing a significant role in that. Now, the key benefits of the platform which we recommend, which is called Solvexia, which is also a hosted platform, but specifically a hosted automation platform, is that it's fast and secure, it reduces the risk of human error, it adds increased control over spreadsheets and increased control over text files, creates full audit trails and up-to-date documentation. So these are all the really important issues. What we can do with that platform, we can automate business processes quickly, really in weeks. Sometimes when you think about these automation projects, you think about months or years even. Whereas with these latest technology platforms, you can do this kind of thing in weeks. You can do it securely and remotely. You can access this securely from any location if you have the right security credentials and links, obviously. So processes that have been implemented using this kind of hosted platform, actuarial evaluations, monthly sales reports, KPI dashboards, client reporting, payment approvals, you name it. There are large numbers of different types of processes that can be automated using such a platform. And we really feel that process automation is a big new area that the insurance sector, for one, needs to embrace, and also the banking sector, where a lot of highly qualified people can be freed to maybe spend their time on expert judgment and maybe calculate their derivatives exposure a bit more accurately and analyze that exposure, rather than being caught up with manual repetitive tasks just to get to the point where you know how much risk you have maybe a month too late. I know some people think if you say to someone, well, we'll give you the FTSE 100 level from a month ago and you can trade on that. A month ago? What is it today? No, we'll tell you that in a month's time. Now that's unfortunately the situation where a lot of companies are with their derivatives exposure. They don't really know what their total exposure is until about a month too late. And by then, you've probably gone bankrupt. So I think process automation is really the best way forward. Right, that concludes this part of the presentation, and I think we'll now open the floor to questions from you guys. So, Josh.
I have put up a table of figures of the total net notional derivatives, and I noticed it fell 20% since 2007, which I thought might be because of the credit crisis. But half of the fall seemed to be between 2011 and 2012. I was wondering if you had an opinion on
Yeah, so you're seeing the part of the G20 commitment is to encourage clearing. So almost like futurisation of derivative trading. So rather than I trade with you in a bilateral basis, I trade with you, but my trade's given up to a central counterparty. So it sits within a secure clearinghouse. And what you're seeing there is a reduction in the outstanding notional because those trades are being pushed through the CCP. That will reduce further over time because client clearing, as of yet, isn't mandatory. It was supposed to have been in place by the end of 2012. Obviously, that hasn't yet occurred. And regulations are still being tweaked by CFTC, SEC, and the guys under EMIR, so ESMA. So we're probably still, I would say, a year and a half away, but you will see those outstanding notionals reduce significantly.
Next question. No? Well, either that means the presentation was exceptionally good or particularly uninteresting. What is your expert judgment on that, Roger?
I think we'll have to look at all the data sources.
Yeah. Well, I think on that note, thank you very much, everyone, for attending. We've got about 10 minutes to grab another coffee and maybe chat about this. Thank you very much. All right.